This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. It is a Fed Wednesday, not a decision, but we're getting the Fed minutes from that first meeting of 2026. Happened on January 28th. You know, that's the meeting when the Fed kept rates steady, and you had two Fed governors, Chris Waller and Stephen Myron, voting against the decision in favor of lowering rates by 1/4 point. So we are waiting for them to cross. They will cross any moment from now.
Yeah, Chair Powell also back then talked up a, quote, clear improvement in the U.S. outlook and said the job market shows sign of steadying, signaling a cautious optimism. All
right, let's head to D.C. and outside the Federal Reserve is our own Michael McKee. Mike.
Okay, here's the headline in a very newsy set of minutes. Several participants indicated that they would have supported a two-sided description of the committee's future interest rate decisions, reflecting the possibility that upward adjustments could be appropriate. The focus of the January meeting on inflation largely, rather than jobs, and concern that bringing it down had stalled. Officials anticipated inflation would move down this year, but the pace and timing remained uncertain. The continuing rise in prices driven by tariffs, the minutes say. The effects would likely start to diminish this year, and ongoing moderation in housing prices would also help. High productivity growth from technology might also put downward pressure on inflation. And a few participants mentioned that companies were telling them they are automating more operations to try to offset some price increase needs. Most participants, however, cautioned that progress toward the 2% objective might be slower and more uneven than generally expected, and judged that the risk of inflation running persistently above the committee's objective was meaningful. Some cited reports from business contacts expecting to raise prices this year. The labor market, the committee's big concern last year, was less of a concern this year. The vast majority of participants judged, the minutes say, that labor market conditions had been showing some signs of stabilization and that downside risks to the labor market had diminished. Still, most agreed downside risks to the labor market remained in place, particularly as the labor supply diminished. Overall, the economy appeared to be expanding at a solid pace with resilient consumer spending and robust business investment, particularly in technology. Several, though, suggested a lot of that was due to spending by higher income consumers. Lower income spending was soft. There was a long discussion of markets, with several commenting on high asset valuations and historically low credit spreads. Some saw vulnerabilities in AI, including elevated equity valuations and gains concentrated in a small number of companies. Several highlighted concern about the private credit sector, and others commented on risks associated with hedge funds and rising leverage. Finally, the January meeting is when the Open Market Committee elects its officers for the year. Jay Powell, again, named chair of the committee, but the minutes say until the selection of their successors at the first meeting of 2027.
Got to say, Mike, it sounds like they all had their Wheaties that morning.
It's a busy meeting, right?
It sounds like they covered a lot of stuff. Hang on for a second, because I want to see what you think is of most importance to the Bloomberg audience. Having said that, just taking a look at equity markets firming up a little bit on the S&P and the Dow, but pretty much NASDAQ 100 staying where it was prior to the Fed minutes coming out. If I look at the Treasury curve, you are looking at pretty much the 10 and 5 where they were prior to the release of the minutes. Looking at the shorter end of the yield curve, slight uptick. The 2-year yield moving from like 345 to 346, kind of back there. So I would say not much market reaction, which is kind of interesting. Mike, what is most notable? Because investors seem to be taking this in stride.
Well, this is the first commentary from anybody at the Fed about the possibility of rate increases. Several, as refers to only 2 or 3 members, and we kind of know who those members might be. But the idea that they did put the idea out there is something that we haven't seen in years, and so it does become a significant talking point as we go forward and watch to see what inflation does. The emphasis clearly shifting to inflation at this meeting from last year's focus on jobs.
Hey, Mike, a couple of the headlines that are worth repeating. Several saw more cuts of inflation declines as expected, yet most caution disinflation could be slower than expected. What could lead to slower disinflation?
Well, they're concerned about tariff price increases, and maybe they don't fade out as fast. And then additional demand in the economy because we're going to get some stimulus from tax refunds and because of all the spending on AI might also push prices higher. So there's concerns that inflation, while it may not rise significantly, could stabilize at a higher than desired level, and that might lead the Fed to have to do something about it.
Hey, Mike, a lot going on. Obviously, there's Fed minutes. We had some economic news today as well. We also had Kevin Hassett out there on a New York Fed tariff study, and I got to ask you about that. He is, of course, President Trump's NEC director, and he says that a New York Fed study showed that the U.S. companies bearing most of the tariff burden is an embarrassment, and the people associated with it should be disciplined. He spoke about this earlier on CNBC. Here's exactly what he had to say. He said what they've done is they put out a conclusion which has created a lot of news that's highly partisan based on an analysis that wouldn't be accepted in a first semester econ class. I've been in that first semester econ class. So, Mike, Fed researchers found nearly 90% of the economic burden from tariffs last year were borne by U.S. companies and consumers. What say you, Mike McKee, and the folks that you talk to, the economic community, who really bears the cost of those tariffs?
Companies and consumers in the United States. Mr. Hassett's comments seem to have adopted the attack dog language of the Trump administration much more than even Kevin had done before, maybe because he's not a candidate for Fed chair at this point. But you got to point out that the New York Fed, by saying 90% is picked up by Americans, is the outlier here, because a study by the University of Chicago found 99%, study by the CBO found 95%, the Kiel Institute in Germany found 94%. So all of these people found that Americans are buying 90% or more, are paying 90% or more of the tariffs. So I think Mr. Hassett has looked at it the wrong way, and obviously the Trump administration doesn't like criticism.
Okay, good to have that on the program, Mike. Just before we let you go, the jobless boom, a most read story on the Bloomberg terminal about the unprecedented jobless boom in the U.S., how economists are warning that the U.S. economy is vulnerable to shocks because the labor market is not growing. Some are predicting that economic growth will slow due to stagnant labor markets. Can't productivity increase as a result?
Well, productivity
of technology,
increase,
as a result of technology.
Yeah. Well, that can happen. The question is, how fast does the technology get adopted, and how quickly and how deeply does it get adopted to drive productivity significantly higher? The concern about the labor market and the jobless recovery is reflected in these minutes, and members of the Open Market Committee did talk about that as a possibility, a possible risk to the economy. Right. Although, as I said, inflation was sort of their number one concern this time.
All right, so appreciate it as always. Our own Michael McKee down there outside the Federal Reserve, or actually inside the Federal Reserve, because it's kind of still cold outside, I think. Mike, thank you so much. Safe travels back. Hey, listen, investors definitely keeping a watch on economic data, Fed expectations. For what else is a top of mind is someone who's been looking at the recent volatility in the markets. He says it's typical of a major investment cycle and that some dynamics around the fear of AI disruption are contradictory. It is the view of our next guest. He is Mike Wilson of Morgan Stanley. He was among the rare forecasters who held on to a bullish view last April, even as stocks sank in the aftermath of sweeping U.S. tariffs. His conviction proved correct, with the S&P, as you know, rebounding to a record as President Trump dialed down his trade war. He does see the S&P rallying, I think, about 16% this year, but that was his call in mid-November. We'll see if he has an update. We welcome Mike Wilson. He's Chief U.S. Equity Strategist, Chief Investment Officer for Morgan Stanley. He's in New York City. Mike, good to have you here. And someone who has followed Mike's calls, and writes about him a lot, is our own Alex Semenova. She's Bloomberg News equities reporter. She's here in studio. We want to talk about the markets, Mike. Are we in the midst of a new bull market and earnings cycle, especially for many of the lagging areas of the index? That was your call in mid-November. Is that a call you still stick to?
Yeah, well, good afternoon. First of all, I would say yes. I mean, the story we actually started writing about in May of last year, which was our mid-year update, was exactly that. I think our view still remains out of consensus around this idea that Liberation Day marked the end of what we call a rolling recession. So we're actually not only in a new earnings cycle, we're in a new economic cycle, and that's why we're seeing the broadening out now, because there have been many parts of the economy that have been sort of mired in a recession for the last 3 years or so, and they're just now starting to emerge. Areas like consumer goods, some of the financial sector, industrials, obviously, which is getting a boost from AI capex, but also getting a boost from, basically underspending for the last several years. Parts of technology are still doing quite well. And so that broadening out is the real story. And we doubled down on that in November because the evidence was coming through. And, in May, we didn't know, but now we know. I mean, the earnings growth for the median stock in the Russell 3000 is now running double-digit growth year over year. That's the first time we've seen that in 4 years. So it's happening. The question now is, how long can it last? What could derail that? And, what do you pay for? I mean, those are always the questions. But the first part of your question is a resounding yes. We are in a new earnings and economic cycle, and the market has figured that out.
Hey, Mike, it's been pretty remarkable to see that we've gotten this tremendous stock volatility at the single stock level, also at the sector level. But when you look at the S&P 500, it actually hasn't really done much this year. What is it going to take to break us out of this range? And what could be the catalyst to get us past that elusive 7,000 level that everyone's waiting for?
Yeah, that seems to be the question. I mean, obviously, stock investors don't. I mean, if you can make money in other areas, that's fine. I think that's the real main message, is that the market is not going anywhere at the S&P level, but there are many sectors that are doing well, and that's the name of the game. Now, to your question, I think what's going to break us out ultimately are two things. Number one, there is some uncertainty around the AI capex cycle and the disruption that perhaps it could cause in the labor market and other areas. So I think we're in one of those testing periods now. We wrote about that this week. We think that ultimately it's a little bit premature to kind of throw a cold blanket on the AI cycle. It's just getting going, from our standpoint. And then secondarily, I think we have a new Fed chair nominee with Kevin Warsh. And the market always tests the new Fed chair, whoever it is, when they come into power or office. And so first we have to go through the confirmation hearings, and then we got to learn a little bit more about what he really intends to do. So that could lead to this, the market kind of struggling for another month or two. And then ultimately we think once he takes office, we think that'll be another catalyst for why the market can have a really good second half. And we stand by our $7,800 price target for the S&P by the end of this year.
Okay, so those are all the reasons and more that you think we could see a 16% increase in the S&P 500 this year. What changes your mind, Mike? What could happen between now and the end of the year that could cause you to go back and sharpen the pencils, break out the Excel, and say, wait a second, we got to recalculate this?
Yeah, well, we do that every week anyways, because that's the name of it, and we have to. But I would say, what would change our view is probably the things that are going right now. So, for example, if we would see the earnings cycle start to deteriorate, and that could happen, it's not our forecast, but if the earnings revisions were to start to narrow again or start to really break down, that would be clearly something that would change our view. The second would be that, the fear around Kevin Warsh being kind of a balance sheet hawk, where, he's going to maybe shrink the balance sheet. And we're going to have a little bit of a liquidity problem potentially. That would cause multiples to come down. We don't think that's going to be the case this year. That might be a story for 2027. We'll think about it then, but maybe we're wrong on that. The other one, of course, is yet another exogenous shock of some kind. And I think, the one I mentioned earlier is starting to weigh on stocks here in the short term, which is this concern that, AI is happening so fast and it's, it's migrating now into the corporate world that we're going to see a big labor cycle. That's not our view, but it could happen. And so those would be the top three, I would say, that could derail our positive view for this year.
We've heard time and time again that big tech's profits are going to slow, that it's time to rotate, and anyone who's said that for the last few years has been wrong on that. Do you think that this year is different? And when you think about the end of 2026, when we close out, who are going to be the new winners?
And I love that you went there because, Mike, it feels like the last 3 years people have said, get away from big tech, diversify, and yet that's where we've seen so much of the gains. It's a great perspective.
Well, I think a lot of people also made the other side of the call, which is to kind of upgrade small caps or the equal weighted S&P. We didn't do that. We don't get everything right, but we waited until November to make that call because our view is not that tech earnings are going to collapse. It's that the rest of the market's earnings are going to improve. And that's what usually drives relative performance. So it's really the spread between sort of the Mag 7 or, large cap growth stock earnings growth and the other 493 stocks or the other equal weighted index, whatever you want to call it. And that spread is narrowing now. And so the areas that we have been recommending is based on where that earnings growth is accelerating the most. That would be things like consumer goods or financials, some of the industrial segments, some of the small mid-cap areas. And we stand by that. That's what we're seeing, and that's what we think is going to continue for the rest of this year. And that's really the story. It's not an anti-tech or anti-large cap growth call. It's more of just a bullish call on all these parts of the economy and the market that have been under earning because of this rolling recession.
So is it fair, Mike, to say that you like the equal weighted version of the S&P 500 more than the main index?
Absolutely. That was one of our lead calls in the November outlook. And that has worked so far. So knock on wood, hopefully that continues. And based on what we've seen so far this year in the earnings and what we see kind of in this, the economy itself, which I think, quite frankly, is booming at the moment because you have capital spending increasing and consumer spending holding up. That's a much better environment for the average company.
Hey, Mike, two things I'm curious about. Do you think the White House is still a risk to financial markets, or with midterms looming, do you think that the president and his team are going to be very careful about unsettling things in the financial markets? Many have said he certainly keeps an eye on it. Maybe that's the checks and balances on the White House. And secondly, Kevin Warsh, if indeed he does become Fed chair, will he be an independent Fed?
Yeah, no, I think that this administration and the president, specifically, has shown that he's going to kind of operate at his speed, and so I don't anticipate that we're going to see, for example, this administration trying to lose momentum in what they're trying to achieve, which means more of the same. Quite frankly, it's going to be active, and that creates periods of volatility, uncertainty, whatever you want to call it. But I think the mission and what they're trying to accomplish is now crystal clear. They're trying to rebalance the economy on three different planes at the same time. And I think they're having some success with that. That's why we're seeing productivity increase already. We're seeing GDP increase. We're seeing earnings broaden out. And so as long as they're seeing results like that, I think they're going to stay the course. With respect to the Fed independence, I have probably had a bit different view here. As far as I can tell, the Fed independence has been sort of fading for the better part of 20 years, really since the financial crisis. And when I say independent, I don't mean they're under the thumb of the White House. What I mean is that they have to play ball in terms of their role to help the government fund itself. Okay, and we saw that after the financial crisis. We saw that in 2012. We saw that, when we had a regional banking stress in 2023. So the Fed is obligated to help financial markets operate. It's their third mandate. They even call it that. So that to me is where the Fed independence has been challenged for the better part of 2 decades, and I think that's going to continue. I think the Fed and Treasury are going to work closer together, similar to the post 2000 World War II period, and that's a good thing because that means they're going to figure it out.
All right. Well, we all want you back here, so feel free to stop by our studio anytime. Mike Wilson, Chief U.S. Equity Strategist, Chief Investment Officer over at Morgan Stanley, and of course our Alex Semenova.
It's 2:21 p.m. here on Wall Street. We check markets for you all day long here at Bloomberg. I'm Nora Melinda. Economic data underscored the strength of the U.S. economy, and Wall Street's worries about AI took a back seat. We had industrial production rising in January by the most in nearly a year, housing starts climbing to a 5-month high in December, and orders for business equipment advancing more than projected in the final month of 2025. Taking a look at some of the major indexes, we have the S&P 500 up about 0.6%. That tech-heavy NASDAQ 100 up about 1%. We have energy and information technologies, the best performing sectors in the S&P 500. Utilities and real estate, the biggest losers. And over in the Dow Jones Industrial Average, we are seeing that higher by about 0.3%. Taking a look at volatility, the VIX hanging just around that 19 handle. The benchmark 10-year Treasury yield hovering about 4.1%. The policy-sensitive 2-year Treasury yield around 3.5%. We have gold and silver both rising, gold just below that 5,000 level, while spot silver is around $77 per ounce. West Texas Intermediate crude around $65 a barrel, with Bitcoin falling to the 66,000 handle. And digging into some of the individual movers, Berkshire Hathaway slashed its holding in Amazon by more than 75% in the fourth quarter, while also building out a stake in the New York Times. Warren Buffett's last new bet as CEO. We do have shares of Amazon. They are higher despite the news, and shares of the New York Times also climbing. Madison Square Garden sports shares are higher. That's after the company said its board unanimously approved a plan to explore a possible spinoff that would separate its New York Knicks business from its New York Rangers business, creating two distinct publicly traded companies. And lastly, Nvidia shares are in focus, of course, after Meta agreed to deploy millions of the company's processors over the next few years, tightening an already close relationship between two of the biggest companies in the AI industry. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Nora Melinda, and that's a Bloomberg Business Flash.
All right, got it. Nora, thank you so much. Well, U.S. Treasury yields, we did see move up today earlier on some strong economic data, including reports on housing. New residential construction in the U.S. rose to a 5-month high in the month of December. That as home builders boosted production to take advantage of lower borrowing costs that were out there. The advance, we should point out, was broad-based, both single-family home starts and apartment projects rising at year's end. The number of one-family homes started was, Tim, the highest since the month of February.
The stronger construction numbers suggest that builders were growing more confident at year's end, even as they continued to sell off a bloated inventory of new houses. For the full year, though, starts notched a 4th straight annual decline. For more on the U.S. housing market, we're joined by Kamini Lane, president and CEO of Coldwell Banker Realty. It's got nearly 49,000 affiliated real estate agents doing business in more than 55 markets across the United States. She joins us from Los Angeles. It's good to have you on the program. The spring buying season is about to get underway. You have agents all over the country who are giving you real-time feedback about what things are looking. This is not a monolithic market. I hear that location is everything. What can you tell us about the state of the real estate industry in the U.S.?
Yeah, we have seen some really good indicators at the end of last year, both in terms of housing starts and in terms of new construction. And, inventory really is sort of the issue to tackle in the housing market right now. We know that, more than 85% of people believe that home ownership is central to the American dream. So that aspiration has not gone away. However, we need inventory. We need inventory to get people into those homes. So, it is location, but it really is inventory. And we see sort of mixed inventory across the country. If you look at sort of the Midwest and the Northeast, we still have really tight inventory, whereas in other markets, we do see loosening of inventory, which is causing more price stability.
Is there anything that gets inventory to increase without actually just building more homes? Would lower mortgage rates increase inventory?
Absolutely. I think, we've talked a lot about that lock-in effect that started occurring because of the historically low interest rates, around post-COVID era, where we saw sellers that were really locked into their homes because they didn't want to give up that 3 or 4% interest rates. So with the loosening of that lock-in lock-in effect. We're going to see sellers who are more willing to put their homes on the market, who are a little bit more realistic about prices, right? Because we're not seeing the double-digit year-over-year price increases that we saw kind of 4 or 5 years ago. And so when we get more sellers to release that lock-in effect, when we get sellers to get realistic about pricing, that's really going to be the other factor, in addition, obviously, to new building, that gets more inventory on the market.
Kamini, that lock-in effect where people, have a low rate and they don't want to move, is it everybody, or is it largely an older population who either maybe retired around COVID or made some decisions, and it's just more to do with demographics than people who locked in lower rates, or is it a little bit of both?
It's everybody. I mean, who doesn't love a 3% interest rate, right? But I think that what folks are starting to realize is that those were historical lows for a reason. And now we are, mortgage rates are about 6%, 100 basis points lower than last year, and very much in line with US historical averages. So I think this idea of just holding on to an interest rate is starting to loosen across all demographics, and people are realizing that there are other reasons to move. Now, you couple that with the increase in home equity and the increase in wage earning over the last couple of years, and folks are really loosening to the idea that low interest rate is the only thing holding them in their home. They're starting to realize that if they do put their home on the market, they can take advantage of some of those equity gains from price increases, and just being more realistic about what rates are in line with historical averages.
You mentioned earlier that I think there's tighter inventory in the Northeast, other areas are looser. Walk us around the country and what you're seeing, and be more specific in terms of markets.
Yeah, sure. So, Texas is one market, Austin in particular, where we are seeing year-over-year price decreases because we've got a lot of inventory there. Florida actually has more inventory this time this year than it did last year, which is sort of an interesting and unexpected dynamic. And one market that I think is fascinating right now is the city of San Francisco. Mm-hmm. We saw year-over-year price declines around the COVID era in the city of San Francisco. And now, because of the AI boom, we're seeing really strong price increases in the city of San Francisco, both in terms of rent and in terms of single family homes. And I think that that's going to continue to increase. So price increases in that city, but not a lot of inventory. I live in Los Angeles, and we're actually seeing sort of a steadying of the market in Los Angeles. We had historical highs in terms of year-over-year price increases a few years ago. And now we see prices are really steadying out in Los Angeles, and supply and demand are starting to even out a little bit.
In Los Angeles, did the devastating fires last year affect the way that people think about living in an environment such as that?
Los Angeles is always going to be a really attractive city. Just the combination of, the weather, the proximity to the beach, the ocean, mountains, the entertainment industry. The fires certainly had a devastating effect on specific communities, but we actually saw, particularly in the high end, that demand that was in the Palisades and Malibu communities that were devastated by the fires transferred almost one-to-one into neighboring communities like Beverly Hills, Bel Air, Santa Monica, Brentwood. And so I don't think that the demand to live in Los Angeles has changed at all because of the fires. We're just seeing a sort of a rebalancing in where folks have moved.
I'm curious to what sellers are having to do. So is it more of a seller's market or a buyer's market, or again depends on the market? And I am curious about when it's new versus previously owned homes, what you're seeing. And I bring that up because Toll Brothers reported after the close yesterday, our own in-house intelligence team writing the post first quarter earnings outlook. First quarter orders were flat, 5% below consensus. It did keep its full year guidance when it comes to deliveries. Management saying January's gotten off to a promising start with most customer metrics modestly higher than last year, though cautioned that it's still early in the spring season. I mean, the spring season is an important one, and I am curious if sellers, particularly new homes, are having to incent buyers, throwing in different things to get sales going, or is that not the case? For new construction, incentives have not actually changed, and so we're not seeing
major shift in the sort of buyer's market or seller's market dynamic with regards to new construction. But to your point, whether it's a buyer's market or a seller's market really does differ around the country, and it really is just dictated by inventory, because the macroeconomic factors around the country are steady, right, in terms of wage increases, in terms of mortgage rates. And so it really is dependent on inventory. So when you look at a market like New England, for example, where we still have very, very tight inventory, that's going to dictate that sellers have a little bit more power than buyers do. However, in a market like Texas, and Texas is very broad, but I'll talk to Austin in particular, we've got a lot of inventory in Austin. And so prices are down year over year about 6%. So that indicates that it's more of a buyer's market, where buyers have a little bit more power at that negotiating table. So, again, inventory really is the thing that's dictating market dynamics across the country, and it very much is region specific.
I'm wondering about compensation for the agents that you oversee. And if we think about the industry, this is one where they're essentially private contractors, right? They're not employed by you. They work for themselves. They eat what they kill. The commissions have been under scrutiny for quite a bit of time. There was the big settlement in recent years. What are commissions looking like in different markets, and is there pressure on commissions as a result of that?
Yeah, great question. So at Coldwell Banker Realty, we have about 49,000 affiliated agents, all independent contractors. And what we're actually seeing is that on the list side, commissions have gone up a little bit. And I think that is because after the massive conversation and the news cycle around commissions, our agents got better at talking about the value that they provide. So at that kitchen table, when you're negotiating with an agent to decide who is going to list your home, which, by the way, the vast majority of Americans have the vast majority of their wealth tied up in the equity of their home. So that is an incredibly important decision. Who is going to help you with the most important financial transaction of your life? Those agents are better able to articulate their value, and consumers are recognizing that, and they're willing to pay for it. And that is what the commission is. It's compensation for the incredible value that the real estate professional is providing. So contrary to what a lot of people assume, we actually have not seen commissions decline in the last year or so. They're actually going up. And I think it really is because of that value that the real estate professional is providing, particularly at a firm like Coldwell Banker Realty.
Kamini, one thing we have to ask you about is AI, the impact. Fortune has a story out from Zillow, citing Zillow's CTO, Chief Technology Officer, and he is saying that AI is reinventing every step of the home buying process, making it easier for shoppers to search for a home and complete a transaction. We've recently seen the AI scare trade impact some of the residential, or not residential, but real estate servicing companies. AI in your world, just got about 40 seconds left here. How is it impacting it so far? And how might it?
Yeah, I think artificial intelligence is an amazing tool to help our real estate professionals use their time more effectively and efficiently. At the end of the day, real estate really is about relationships. It's the most personal transaction that most people are ever going to encounter in their lives. And so that really does require a human at the center. However, AI can make that human more powerful, use their time more efficiently, use data more efficiently, and be more effective in that transaction.
So real quickly, it's an aid. It's not going to wipe out what you guys do or your agents
Absolutely.
do.
No, it is an aid. It is an empowerment tool, but real estate is fundamentally human.
All right, going to leave it there. Kamini Lane, thank you so much. President and CEO of Coldwell Banker Realty joining us. When we come back, Warren Buffett's latest bet as CEO.
It's 2:40 p.m. here on Wall Street. We check markets for you all day long here at Bloomberg. I'm Nora Melinda. A rebound in stocks is gaining traction amid easing jitters around AI disruption. Meanwhile, a slew of data did show that the U.S. economy is holding up. Taking a look at some of these major indexes, we have the S&P 500 up about 0.4%. That tech-heavy NASDAQ 100 up 0.7% higher, and the blue chip Dow Jones Industrial Average up about 0.2%. Taking a look at the volatility in the market, we have the VIX hanging around the 20 handle right now. The policy-sensitive 2-year Treasury yield hanging around 3.5%. And the benchmark 10-year Treasury yield hovering around 4.1%. Gold and silver both rising. We do see gold is up at $49.81. We see spot silver at $76.71. And oil jumping. We have West Texas Intermediate crude oil at $65.1 per barrel. Bitcoin falling more than 2%, hanging around that $65,000 handle. And digging into some of the individual movers, we have Palantir shares. They are rising. This is after Mizuho upgraded the company to outperform from neutral on spectacular growth and expanding margins. We're also looking in the real estate space at Toll Brothers. This company's been in focus after its quarterly orders fell short of analyst estimates. This signaling that fewer people are signing contracts to build homes as high prices and economic uncertainty hold some buyers back. And lastly, over in the healthcare space, Moderna keeping that in focus as well after the FDA said it will review its flu shot made with mRNA technology, reversing a previous decision that shocked Wall Street and spurred a public spat between the company and its regulator. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Nora Melinda, and that's a Bloomberg Business Flash.
All right, Nora, thank you so much. Carol Massar along with Tim Stenovec live here at Bloomberg headquarters in New York City. Well, the 13F filings have been coming out, regulatory filings. Yeah, we kind of love it.
Yeah.
Right?
Well, it sheds a little light on something that's not necessarily very transparent, but it's backward looking.
It is backward looking.
But it's still, stocks move as a result.
Well, and when it relates to like Berkshire Hathaway and Warren Buffett, like we definitely take note. And on that, this did catch our attention. Berkshire Hathaway slashed its holding in Amazon.com by more than 75% in the fourth quarter. There were a few other actions. We're going to get into that in just a moment, including building a stake in the New York Times company. It's a move that is Warren Buffett's last new bet as CEO. We want to get into, though, all of the movings around, if you will, over at Berkshire and some of their holdings. Bloomberg Intelligence Property and Casualty Insurance Senior Analyst Matthew Palazola is here in studio. And speaking of insurance, Berkshire did increase its stake in Chubb during the period. Matt, good to have you here. You do keep a watch. I know insurance is really your bailiwick and what you watch, but walk us through kind of what we learned about Berkshire and some of their holdings.
Yeah.
And this was kind of significant, right? Because it was the last time.
Yeah, no. So we were saying before, it's really sad to see that it was Buffett's last quarter as CEO. We don't know exactly if he's behind all the moves. He's been careful to say, sometimes people say, I did it and I didn't do it. He won't tell you who did it, but so we don't know exactly what he was behind. But so you mentioned Chubb. Chubb, they are now the second, or they were even before, but they're the second largest shareholder in Chubb. Chubb seems like a stock that Warren Buffett and Berkshire Hathaway would like to own, I think. It's a cream of the crop insurer. I would consider it probably world-class, best in the world, still growing at a decent clip with excellent margins. Now, the interesting thing is Berkshire has their own massive insurance business. So part of the Berkshire playbook is, we take smaller bites of a company and maybe make something big. I don't want to cause too much speculation. I don't know. I mean, one thing I would say is for the size of those two insurance businesses, they're actually very complementary. So it does lead to some speculation
that they would fully acquire.
That they would want to fully acquire Chubb.
It's a $129 billion market.
Right, and now Berkshire,
they have the cash, as you pointed out.
Yeah,
they have $380 billion in cash, so theoretically they could buy it. There's probably some culture issues there, some antitrust issues, but as an insurance analyst, I dare to dream about that kind of mega merger.
Help me with that, because Tim and I were talking about this. I went to the FA function on the Bloomberg, and I thought the balance sheet showed more than $700 billion in cash and equivalents.
I think that's high. That might be including some of their investments, because the cash is definitely like 380, and then the investment portfolio is around 300 as well.
So you could do some stuff with that.
I think so.
People love to look at the cash holdings that Berkshire Hathaway has as a sign of, being on the sidelines waiting for an opportunity. And maybe that opportunity comes in the form of the New York Times, or maybe it comes in the form of an increased investment in Chubb. But some people point to the idea that, well, valuations are just really high across the board right now. We don't want to be buying anything. Can we get that at all?
That's what I've felt from Buffett. I mean, look, Buffett's been old. He's been stepping back from the day-to-day. They've been a net seller of stocks for, I believe it's 13 quarters in a row. And we're not talking by little amounts. It's like $5 billion a quarter that they're a net seller of stocks.
And during that time, the valuations have
only gone up.
Yeah, I mean, 3 back-to-back years of double-digit increases.
So it kind of gets caught in that loop of it's too expensive, and then it's getting more expensive. And the other thing, though, is Buffett is not really ever timing the market, and I think Greg Abel, his predecessor, will be the same way. They're looking for quality companies, and I think some of it lent itself to the valuation, some of it lent itself to, I think Buffett was kind of just slowing down and looking for opportunities. One thing I'd say, not in the 13Fs, is their Japanese holdings have done quite well. So it's not something that gets a lot of attention because I don't think we understand it incredibly well.
How much exposure do they have?
So they have the holdings, I think, are about $20 billion now. So it's one of their biggest holdings at this point. It doesn't show up in those 13Fs because it's a non-US holding.
Okay. Yeah.
But that was probably the biggest move in terms of stocks that they made over the past couple of years.
Speaking of moves, though, if you look at the New York Times, it hit an all-time high today after getting Buffett's blessing, whether it was he and the team or what have you. I mean, we know he likes newspapers. We know that. I know you're the insurance guy, but you understand kind of the thinking of how they invest and what they invest in. I mean, does it feel like a typical Berkshire or Buffett buy? And I kept thinking, well, maybe he wants to buy it or maybe he wants to protect media. I don't know.
It's possible. I don't know if he'd make kind of an activist type move on the way out. We were talking about perhaps them being better in video or things like that. So like not
They're
a
digital.
bad,
Like
the digital side.
Really
and
well.
They made an investment in Sirius XM and they own this Liberty Media stock. So it's not completely foreign for them to be in this type of realm.
Yeah.
So I could see it that way.
What about cutting a position in Amazon by 75%?
So the position in Amazon is interesting. So it wasn't Buffett's initial idea. They started it in 2019. They brought it to him. He said, and again, they talk about how Buffett didn't necessarily want to invest in tech, but I think he viewed it as retail versus like a tech play. We calculated that position was up 130 to 140% for Berkshire in the time they held it, which is great. But it's also pretty much in line with the S&P 500. So I feel like you're looking at that and you're saying, okay, we've got this tied up in this kind of Mag 7, potentially volatile name, and perhaps we take some off the table. I think they sold about 1.7 billion of that, which is smaller. It's still smaller than the positions they cut in Apple and Bank of America.
I mean, are we expecting Berkshire Hathaway in terms of the holdings to change dramatically? I mean, this feels like a company that buys and holds for a while.
Yeah. So I'd say a couple things, Carol. The past couple of years, they have made smaller investments where they've kind of moved in and out of them. And those were not needle moving for Berkshire at all. I would think Greg Abel taking over, he will, it's not fully clear, but I believe he will have the discretion over the investments. He has the investment deputy. But I think he just maintains the ethos of Berkshire, at least for the next couple of years.
I mean, it's worked.
Exactly.
Do we read too much into this? The quarterly moves?
I think so.
Do we?
Yeah. I mean, it's always good to get these little clues, especially with Berkshire. They don't do conference calls. They don't talk to analysts. So there's not much to do. Yeah, the website is from 1987. And so we kind of looking for little pieces here and there.
Maybe he just likes Wordle.
Little pieces.
So he wanted the New
little
York
pieces
Times.
of See's candies, if you will.
No, I'm just saying Wordle. Maybe that's what he just wanted access. Hey, we should also point out he increased Berkshire stakes in Chevron as well.
So the interesting thing there was, maybe it was some kind of play on U.S. intervention. They did it last quarter, so it was before Maduro got taken out. Chevron will be a big beneficiary of U.S. With more direct involvement in Venezuela oil. So they owned a lot of Chevron anyway.
Yeah.
But so it could have been the tea leaves, maybe not.
Wordle, New York Times.
See's candy.
I know.
But
Always
still.
sees candies.
Well, you kind of
I know.
go with what you like.
Now I'm hungry.
As Warren Buffett says.
Yes, he does. Matt, thank you so much. Matt Palazola. He is Bloomberg Intelligence Property and Casualty Insurance. When we come back, a check on stocks on the move. This is Bloomberg.